You worked hard this month. Your employer said you'd earn $55,000 a year, so bi-weekly, that's about $2,115 per paycheck. But when the money hit your account, it said $1,535. Where did the other $580 go? Is this a mistake? Is this normal? And, most importantly, will you ever see it again? Today I'm breaking down every single deduction on your Canadian pay stub, line by line, so nothing surprises you again. The good news? Almost all of this money is going somewhere that actually benefits you. Let's get into it. The first deduction on your pay stub is CPP, the Canada Pension Plan. Think of it as a forced retirement savings account, except the government manages it, and your employer helps fund it. Every paycheck, 5.95% of your earnings is deducted for CPP. And here's the part most people miss: your employer contributes the exact same amount on your behalf. When you reach retirement age, currently 65, CPP pays you a monthly income for the rest of your life. The more years you work in Canada and contribute, the higher your monthly payment. In 2024, the maximum monthly CPP retirement pension is $1,364. As a new PR, every year you work and contribute counts toward that number. The next deduction is A, employment insurance. This one is smaller. At $55,000 per year, it's roughly $37 per paycheck. A is exactly what it sounds like, insurance. You pay a small amount every paycheck so that if something happens, you have income to fall back on. To qualify, you need between 420 and 700 insurable hours worked in the past 52 weeks. The exact number depends on your region's unemployment rate. If you start working right away, you can qualify within a few months. The maximum A benefit in 2024 is $668 per week, for up to 45 weeks. A is not a tax either. It's a safety net that you and your employer pay into together, and it's there when you need it most. Income tax is split into two parts: federal tax, paid to the Government of Canada, and provincial tax, paid to your province. At $55,000, you'll typically see about $200 in federal tax and around $140 in provincial tax per biweekly paycheck. These numbers shift depending on where you live. Here is the single most important thing I want you to understand about Canadian taxes. Canada uses a marginal tax system. You do not pay the same rate on every dollar you earn. Think of it like a bucket ladder. The first $15,705 you earn is completely tax-free. That's your basic personal amount, a credit everyone gets. The next portion up to about $57,000 is taxed at just 15%. Only income above that moves to 20.5%. So if someone tells you, "I don't want a raise because I'll pay more tax," that is a myth. You always take home more money with a higher salary. Quebec has a separate provincial return and higher rates, but also the most services, subsidized $10 per day daycare, lower tuition, and more. Alberta has no provincial sales tax. Ontario sits in the middle. If you're in Quebec, you'll file 2 tax returns every April, one with the CRA and one with Revenue Quebec. Every other province files one combined return. Let's now read an actual pay stub together. Every employer's format looks slightly different, but the structure is always the same. At the top you'll see your gross pay, what you earned this period before anything is taken out. This is the number your annual salary is based on. Below that, your deductions. You'll see CPP employee, A employee, federal income tax, and provincial income tax. These 4 appear on every Canadian employee's pay stub. At the bottom, your net pay. This is what actually lands in your bank account. One thing that confuses many new PRs: your employer estimates your tax based on your salary and withholds each paycheck. If they overestimated, you get a refund in April. If they underestimated, you owe a small amount. Either way, it gets corrected at tax time. Some employers also deduct for group benefits like dental and health insurance, or an employee pension plan. Those appear separately from CPP and EI. Let me leave you with one concept that will help you understand your taxes for the rest of your life in Canada. Your marginal rate is the rate applied to the next dollar you earn. At $55,000, your combined federal and provincial marginal rate is about 26 to 27%, depending on your province. Your effective rate is the actual percentage of your total income that went to tax. Because part of your income was tax-free and part was taxed at 15%, your effective rate is much lower, often around 18 or 19% at this income level. So when you read a headline saying, "Canadians pay high taxes," remember, that headline always quotes the marginal rate. The average burden across your full income is considerably lower. And that tax funds your universal healthcare, your children's schools, your roads, and, as we covered, your future CPP retirement income. So to recap, your paycheck has 4 standard deductions. CPP builds your retirement. A protects you if life throws something unexpected. Federal and provincial tax fund the services you and your family use every single day. You now understand every number on your pay stub. If you want to legally reduce how much tax you pay and keep more of your money, the next video is going to show you exactly how, using RRSPs and TFSAs. 2 accounts every new PR in Canada should open in their first year. I'll see you there.